Good morning, everyone. Thank you for joining us for the ERM Toolbox Training webinar. A few housekeeping notes that I want to remind you of. If you've dialed in by phone but not have logged in by your computer and you'd like to see the slides for today's webinar, please point your web browser to readytalk.com, and in the box that says Join a Meeting, enter the same access code you used to join the call, which is 987-9821. Please stay aware of the level of the background noise in your area. If it becomes busy, please do not put your phone on hold so the background noise isn't transmitted to everyone on the call. If you're called away from your phone, please do not put your phone on hold. If you put your phone on hold, your whole music will be played to everyone else in the call. If you need to leave the call, you can simply hang up and then dial back in when you're able to, and it will not disrupt the others. We're leaving the phone lines open and unmuted, so if you have any questions, you can ask them that way, and also you can use the chat box in the lower left-hand corner of your window. If you type a message there, it will be displayed for the chairperson to read. And again, please do not put your call on hold, and I will now hand the controls over to your presenter, Sean Ryder of Willis.
Good morning in California, and good afternoon to any of you who are here on the East Coast like I am. My name is Sean Ryder, and I'm with Willis's captive practice. Willis is a large global insurance broker as is the case with any large insurance broker, we need to have a captive capability ourselves, as captives are a fundamental part of how large organizations utilize or manage their risks. I lead Willis's global captive practice on the consulting side. So we have consultants scattered around the world, and I am the managing director of our consultancy operation for captives. My personal background is that I've been in captive consulting or in the captive space now for about 14 years in various functionalities on the insurance company side of captives, on the captive management side, and on the captive consulting side. I help people understand whether or not captives make sense for them. I help them understand whether or not the captive they have continues to make sense for them. And I help them build their strategies around the captive concept and integrating a captive into their overall insurance program and into their enterprise risk management platform. Today we're going to be doing a bit of a captive primer. We'll be focused on the basics around captives, how people use captives, what they are, and how they integrate into an enterprise risk management or global insurance program. We have some diversity of topics. I encourage folks to reach out via the chat box if they have any questions or comments, and I'll make every effort to address your question during the presentation. So to move forward, what is a captive? A captive is an insurance company that you own. So if you're a large organization like you see, you have the opportunity to create your own insurance company, and for your own insurance company to insure you for risks that you don't wish to put out into the commercial insurance market. An organization, when making insurance purchasing decisions, first decides on whether or not they want to transfer risk to a third party, like the Hartford or Zurich insurance companies, and they also need to decide if they want to retain certain risks, like risks underneath a workers' compensation deductible, as an example, or underneath auto liability deductibles. When an organization decides to retain certain amounts of risks, as all large organizations do, then the question is a captive a tool for managing the retention of that risk? Is creating your own insurance company to insure yourself one of those tools that enhances enterprise risk management efforts? There are other areas in which captives are used, and I'm going to be going into those shortly, but fundamentally, a captive is an insurance company that you own. It's a real insurance company. It is an incorporated company. It resides in a domicile that enables captive insurance companies. It has a board of directors. It has internal governance and controls. It has external audit, and it makes filings to its regulators. So a captive is not necessarily an offshoot or I guess a Mickey Mouse type company. It's a real insurance vehicle with governance controls and internal processes and external regulatory requirements and oversight. Captives can provide both insurance and reinsurance to their parent and to their parent's insurance partners. Insurance, of course, is when an organization like the UC, a company, I'm going to use the word company because organization will get back and we'll go back and forth quite a bit. But when a company buys insurance, they transfer risk to a third party. When an insurance company buys insurance to transfer some of its risk to yet other third parties, that's called reinsurance. So a captive can be both an insurance company and a reinsurance company, meaning it can insure the UC and it can reinsure the insurance companies that insure the UC. Now, fundamentally, captives are specifically designed to insure the risks or reinsure the risks of its parent or associated third parties. In an enterprise risk management program, we don't just look at what exactly are the corporation's risks, what exactly are the UC's specific risks related to its corporate responsibilities. In enterprise risk management programs, we look at risks that are beyond the scope of simple corporate insurances, but look at risks related to associated parties, such as students, as a perfect example. When we look at organizations like the UC and vendors, as an example, who have a large swath of associated third parties who are in partnership with the organization, a captive can become a very effective mechanism for taking those risks into the corporate family and treating them with the same level of enterprise risk management discipline and expertise that one can deal with their own corporate risks. When we look at the risk financing continuum, which is what this slide is meant to represent, we see on the left axis we have program control. That really gets to your ability to control the terms and conditions and pricing of your insurance program, the insurance programs that you buy. On the bottom axis, we have financial control. Financial control speaks to your ability to participate in the profitability of the insurances that you buy, your ability to reap the rewards of investment income associated with the insurance premiums or the risks that you have, and your ability to control also to a certain degree the price of your insurance program. And as you move up the continuum from a guaranteed cost insurance program, where I personally buy a guaranteed cost insurance program practically for my house. I pay a premium, and I really don't have to worry about it. If I have a claim, I don't really have a deductible of any note, and I cut a check and I don't have to think about it. My house burns down, they cut me a check and we're done. That's a guaranteed cost insurance program. Now, large organizations like UC don't really have a lot of guaranteed cost insurance programs because it doesn't make sense. Your insurance programs and your risks are so dynamic and sizable that it really makes sense to retain some of the risks yourselves. It's more financially optimal to do so. Retain some of the risk yourselves, and in doing so, move up the risk financing continuum towards deductible policies. And a deductible insurance program is a very common tool in alternative risk finance in which you decide to take a large deductible yourselves and to assume some of the risk and manage some of the cost associated with your own losses and your own claims exposure. It's a common tool within enterprise risk management platforms. As we move further up the risk financing continuum, we move into the world of captives and self-insured trusts. The University of California has self-insured trust mechanisms. Single-parent captive mechanisms is really what we're talking about today, where you as an organization could very well consider utilizing a single-parent captive in order to help manage the risks from an enterprise risk management basis. And as you move up this continuum, you have more control of your program. You have more control of the financial outcomes of your program. It's worth noting that a single-parent captive is below on the continuum as compared to a self-insured trust. And that's because a single-parent captive program, a captive insurance company, as I mentioned, is a regulated, audited, actuarially reviewed entity that has a board of directors and internal controls and governance where self-insured trust doesn't necessarily have that same level of robust infrastructure. As a result, a self-insured trust is an alternative risk financing mechanism that's further up the continuum because you have a little more control yourself in many aspects. Moving forward, why do folks form captives? All right. One can imagine that in a hard market, meaning when insurance costs are rising, and insurance capacity, meaning the willingness of insurance companies to underwrite your risk, insurance capacity is tightening, meaning it's becoming less available, that the utilization of captives would be greater and greater, and that is true. As price goes up and as capacity becomes more constrained, folks have a natural predilection to taking on greater degrees of self-insurance or risk retention. And as a tool to provide a framework for risk retention, a captive becomes a very viable mechanism for folks. But also in markets in which price is not necessarily going up dramatically and capacity is not necessarily tightening dramatically, captives still become an excellent tool for organizations because they provide a level of governance and controls, transparency and validation around retained risk positions that can be very effective. They also provide access to capacity and to reinsurance markets that might not otherwise be accessible to an organization. And lastly, they provide an opportunity for an organization to help support the risks of their third parties, their affiliates, so whether it's their vendors, in your case, vendors, physicians, students, looking at insurance programs for those folks to help support the UC's mission, looking at insurance programs for those folks to help support their daily living and their engagement with the organization. A captive is an excellent tool for enabling that kind of supporting behavior. So why we see captives growing in the captive space is looking for capacity, looking to control frictional and non-loss costs. But you'll see, really, it's about control. A captive is a great mechanism for taking control over programs, of an insurance program's financial outcomes and its parameters to provide broader coverage than the commercial marketplace might otherwise be able to provide, to return profitability in insurance programs back into risk management outcomes, enterprise risk management practices and grants, and really the opportunity to drive down the cost of risk through improving outcomes and reducing claims for folks. One of the interesting things about insurance, in my view, is that when we have programs, loss control and claims management programs, particularly loss control programs, they can sometimes be viewed as a bit of a burden. But fundamentally, what they're trying to do is to prevent not just losses from happening, but losses emerge as a result of people becoming injured or suffering in some way, shape, or form. So it's really to the insurance industry and its loss control efforts is really looking to reduce adverse outcomes as they impact people's lives. So programs, infrastructures like captives can be, their outputs can be converted into those kinds of measures. So to have a very positive effect, with respect to a variety of constituents. When we see how folks use captives from a line of business standpoint, just about any element of insurance, just about any element of the insurance marketplace can have a role or can be involved in a captive utilization strategy. When we traditionally started with captives in the development of captives, and by the way, captive is an old tool. The first captives were created in the 50s in Bermuda by large global organizations who were having trouble with their property insurances and having trouble with their general liability insurances. It's worth mentioning that, as we say in the alternative risk market space, innovation in insurance never comes from insurance company executives, or rarely comes from insurance company executives. 99% of the time, it comes from insureds, from folks like yourselves who are frustrated by the commercial marketplace, who are frustrated by the cost and capacity and the coverage terms and conditions, or the overall marketplace and the way the marketplace behaves in the insurance space, and are finding that the commercial market does not provide solutions that folks need. The invention of captives was built, it's a direct offshoot of innovation on the part of insureds who are frustrated by the commercial marketplace. And the expanded utilization of captives over the course of the past 60 years has reflected that. Now, where we see captives traditionally being focused on workers' compensation, auto, general liability, and products liability as kind of the basis for how folks use captives, or kind of risks that they put into their captives, we're seeing that now being expanded out into employee benefits and terrorism risks. We see it in equipment maintenance programs and construction programs and trade credit risk, risks that have a greater deal of volatility but also have a tighter, more constrained marketplace. We also see, on an emerging basis, right, on the very front end of captive utilization, we see frustration in the commercial marketplace right around self-insured medical stop loss, around reputation, brand, and loss of income risks, intellectual property risk. We see organizations that are finding the marketplace is very challenged to meet their needs in that space, so they turn to their captives in order to meet their needs. One of the keys to understanding how a captive works within an organization is that captives oftentimes or predominantly are risk financing mechanisms, meaning they aren't about taking risk off the balance sheet. What they are is that they're about providing governance and control and funding around risks that are on the balance sheet, and that are on the balance sheet either because we've decided to take the risk on and not transfer it, or because there is no commercial marketplace available. So for organizations who are frustrated by the commercial marketplace and don't really have many opportunities, or don't feel that the commercial marketplace is meeting their needs, captive is an excellent tool to provide governance and visibility and infrastructure around those retained risks. It's also an excellent tool for organizations who decide to take on certain risks to have that same kind of governance and control around their retained risk. What a captive can do for an organization is really broad in terms of its utilization and its technology. It can be a governance tool, it can be a funding tool, it can be a tool for helping in allocating risk, allocating cost of risk between internal stakeholders. It can be a tool for accessing reinsurance markets. I'm going to get into that in just a few moments. In fact, I'll get into that during the next slide. Before I go into how captives are used from utilization technology, are there any, we do. How does a captive differ from a self-insurance program? From Andy. Andy, thank you very much for your question. A captive is we'll talk about this in a few minutes. When we see the types of captive utilization that's up on the screen right now, right, there are four, in my view, main buckets of the way folks use captives. There's captives as a tool for retained risk finance, for risk transfer rate arbitrage, for accessing certain kinds of capacity, and for entrepreneurial utilization. And Andy, to answer your question, a captive differs from a self-insurance program in the three buckets to the right. In the retained risk finance bucket, what a captive provides is a funding mechanism and a governance and controls mechanism around retained risk, around self-insurance. When we're talking about deductibles, or we're talking about being a qualified self-insurer, or talking about retained risk, we're fundamentally talking about the same thing. There are some infrastructure differences and some technical differences from an insurance and regulatory standpoint, but taking a deductible and being a self-insured is both retained risk. Right? So in a captive mechanism, as I've described so far for the most part, as a retained risk finance tool, how it differs is it provides a greater degree of governance and controls. It provides greater transparency and a regulatory framework around retained risk finance. It also provides the opportunity to pool different elements of retained risk. You may have workers' compensation, professional liability, cyber risks, all within your retained risk bucket. And with the captive mechanism as a unified place, the repository for all of your retained risks, all of your self-insurances, all of your deductibles, a captive can be a tool for pooling those risks and managing and having good outcomes in one area and having bad outcomes in the other, being able to pool those dollars in order to create kind of a degree of smoothing with respect to the impact of retained risk on the overall organization. Dan, I'm going to come back to your question on slide 4. Where do you see the UC and what opportunities do we have? Allow me to walk through the rest of this, and then we'll come back to that one. And for Saladin, a governance tool, excellent. and Dan, again, on the risk financing continuum. Allow me to come back to that in a little bit. On the governance tool, a captive is an organization, like I said, it's an incorporated entity, domicile, that supports the creation of captive insurance companies. I'll get into domicile in a little bit. And that captive has a board of directors appointed by its shareholders. That board of directors has annual board of director meetings. The captive will oftentimes have underwriting committees, audit committees, loss and investment committees, and they will be focused on the risks that reside within that captive, looking to mitigate those risks and build infrastructure to drive down the cost of risk. It partners very nicely with enterprise risk management programs in that it provides leadership a greater opportunity to focus even more fully on the cost of retained risk within an organization. A captive also is required to have an annual actuarial analysis of its reserves, so you have third-party validation of reserves and the appropriateness of reserves. It also is required to have a third-party audit, an independent audit, audit the financials of the captive, and then it's required to file its financial statements, its audited financial statements, and its actuarial work to the regulatory authority in its domicile. So you have, in addition to having external service providers in the form of insurance professionals and captive managers, you also have actuarial, audit, and a regulatory Department of Insurance looking at your captive and kind of validating the appropriateness of the funding for those retained risks. When we get to, I'm going to go back now to the slide that's in front of you, captive utilization. I'm going to drill down into each of these to a certain extent, but I want to focus on wrapping this up in the next 20 minutes or so we have 15 minutes for some more focused Q&A. On the retained risk finance, as I mentioned, this is when a captive folds neatly into your retained risk or self-insurance or deductible programs, that it provides an infrastructure for providing transparency, validation, rationalization of retained risk positions, which really gets to the question of governance that I just addressed. It enhances risk management efforts by being a mechanism by which investment income can be collected, underwriting profitability can be collected, meaning if there are surpluses in funding, those can be converted into loss control efforts and claims management and mitigation efforts. And the accelerating tax treatment of deductible liabilities doesn't apply to the University of California as a governmental instrumentality, but for large corporations, it can be a high-impact value proposition. The next bucket is about risk transfer rate arbitrage. Right? In a hardening market or in a dynamic marketplace, commercial marketplace for insurance, there are circumstances that arise periodically in which the cost of risk transfer, if you buy it from an insurance company, is more than the cost of the same risk transfer if you buy it from a reinsurance company. And this is kind of the difference between buying your plasma TV from a wholesaler as opposed to buying it from a retailer. Right? The retailer needs to have advertising in all sorts of shops and has to have locations all over the country and has to have lots of staff, where the wholesaler is just a warehouse with an online storefront. Similar model in the insurance-reinsurance space. Insurance companies need to have acquisition costs, they have greater degrees of infrastructure, they have presence in diverse locations, where reinsurers tend to be concentrated. They don't advertise, they don't go out and seek business from folks like the UC. Instead, they seek business from insurance companies. They have a much smaller marketplace. As a result, their costs, the cost baked into their premium can be a bit lower. So every now and then, there are certain kinds of risks, whether it's environmental risks sometimes, or product liability risk, or intellectual property risks, or we've seen it with professional liability risk on occasion, where purchasing the same risk transfer on a reinsurance basis as opposed to purchasing it on an insurance basis can be more effective. Well, in order to get to the reinsurance companies, you have to be an insurance company yourself. Well, captive qualifies under that parameter. So as a result, when there are opportunistic scenarios where you can buy the same risk transfer from the reinsurance marketplace for sufficiently less than buying it from the insurance marketplace, a captive as a risk transfer rate arbitrage tool can be very effective. Similarly, there are certain kinds of capacity that can be accessed on a reinsurance basis that can't necessarily be accessed on an insurance basis. So capacity meaning coverage terms and conditions or just willingness to provide certain kinds of coverage. As an example, environmental liability usually has a 10-year reporting period. There was a firm we were working with a little while ago that needed more than 10-year reporting period. They needed a 20-year reporting period as a term and condition under the environmental liability program. Well, no insurer was able to provide that, but there was a reinsurer in Europe who was willing to do it. But the only way to get to that reinsurer was to have your own insurance company, or to have an insurance company to get there for you. And in this case, the client went with creating their own insurance company to do that. So access to capacity means being able to find risk transfer markets that just aren't even available to you on an insurance basis, but only available to you on a reinsurance basis. Another model around that is terrorism. Terrorism risk in the U.S. is supported by a U.S. federal program called TRIA, or TRIPRA now. And the reinsurance, it's not really reinsurance, it's a federal backstop, but it behaves like reinsurance, protects insurance companies. TRIA supports the purchase, supports or provides a backstop to nuclear, biological, chemical, and radiological terrorism coverage. Well, the insurance companies don't provide that because they're not forced to provide that. But TRIA will respond. It will backstop an insurance company if it chooses to. So we found that organizations who have a need for nuclear, biological, chemical, and radiological terrorism insurance, right, are very effectively forming their own captive insurance companies, writing the insurance program with those triggers, and being able to access the federal backstop. So this is another area where access to certain kinds of capacity or certain kinds of backstops can provide a value proposition for the formation of a captive. And then lastly, we have entrepreneurial utilizations. Entrepreneurial utilizations is really a bit of a misnomer, perhaps. When we look at third-party risk in an enterprise risk management program, there are third-party risks that are truly entrepreneurial, like when you go to a big box retailer and you buy your plasma TV and they say, do you want the service contract? Well, they're selling you insurance in most states. Right? And when they sell you that insurance, that's an entrepreneurial insurance sale, and if that risk ends up in their captive, which in most cases it probably does, then that would be an entrepreneurial utilization of captives. Right? However, there's also scenarios, and the UC has several of these, where there's affiliated third parties who have a need for certain kinds of insurances, whether it's small vendors who come on campus in order to speak, be a guest lecturer, whether it's organizations that come on campus or within the organization in order to help on construction projects as vendors, whether it's students who have a need for certain kind of insurances or alumni associations, or perhaps even for physicians in the health systems. In the health systems. Those are third-party risks that are not necessarily the UC's corporate kind of universe, but are certainly affiliated and are certainly part of the contributors to risk for the University of California, and as is the case for all major health systems and all major universities, in building an enterprise risk management program, right, one identifies these as contributors of risk. Well, it would make sense then to build an insurance program that folds them into the enterprise risk management loss control and best practices regime that one has for the corporation, and a captive can be an excellent tool for building insurance programs that both meet their needs and meet the UC's needs, but are also financially optimal for all involved. So entrepreneurial utilization really should be renamed as third-party risk, whether it's affiliated or unaffiliated third-party risk, as an excellent tool for captive utilization. I'm going to be advancing a bit now to go a little deeper into retained risk finance. There are three ways in which organizations really work on retained risk finance. And I'm going to focus on deductible reimbursements and catastrophe excess programs. This webinar, by the way, is going to be online, so you'll be able to go back to it and I drill down if I breeze through any of it in the interest of time. But deductible reimbursement programs are designed to fill the spot where you have a retained risk in your deductible program. So if you have a large deductible in your workers' compensation program, your captive can fill that gap that exists in the deductible or some portion of it in order to transfer those risks from like a self-insured trust down into a captive mechanism. And we see this in terms of a line of business basis. We see this across the board, both in the benefits and commercial property and casualty side. And that really works with frequency-oriented risk. You'll see that these are all frequency-oriented risks, where you have many claims. They aren't necessarily large claims, but there's a substantial amount of funding associated with them because there are many of them. On the catastrophe excess side, we see claims that are infrequent but that are potentially severe. And a captive can build a program, can be part of an overall placement of risk, a tower of risk, if you will. If you buy $100 million of coverage for, I have to find one here, reputational risk. Right? A captive can participate in that tower in spots where it's difficult to build out a tower, or where you decide to take a layer of risk yourselves in an excess program. A captive can be a funding mechanism for that. And when you're building catastrophe programs, certain layers and the pricing of certain layers can be driven by whatever participant in that layer has the highest price. So a captive can be a great tool for taking out that high price participant who's driving the cost of the entire layer and replacing it with a captive and moving down to the next highest price. So it can be a great tool for building financially optimal catastrophe programs. The other one is global fronting. If you're a global organization and you have a need to show evidence of insurance in Brazil as an example, but you have a large deductible program and you need to show evidence of insurance on a guaranteed cost basis, you can partner with an insurance company to provide evidence of that insurance, and then for your captive to reinsure that insurance company for the risk that you wish to retain. The next few slides, and the global fronting program, you can read further on that in future. It really isn't particularly relevant to the UC, but if one is going to be conversant in captives, this is a major area in which large global organizations utilize captives. On the deductible reimbursement side, as I mentioned, my key characteristics for how folks use these programs are frequency-driven, long-tail, high-volume liabilities. So, Dan, to answer your question from earlier, where do we see the UC and what opportunities do we have? Well, in the frequency-driven, long-tail, and high-volume liabilities, I think that this is an excellent place for the UC to use captives. The captive can help equalize or balance funding that are in your existing self-insured trusts under your deductible program on the casualty program, and in doing so, take successes in one bucket and lever them into offsetting adverse case outcomes in another bucket, and as a result, not need to go back to the well to fund certain trusts. I think that's an excellent tool on the deductible reimbursement side. I also think that it brings a greater degree of visibility. I mean, the UC has an award-winning enterprise risk management program, has tremendous visibility at the Regents level. This is an opportunity to bring even yet more visibility to the cost of risk to the organization by including stakeholders in the captive mechanism. So it's a great tool for funding loss control, risk management, claims incentive programs because when you take dollars, you put them in your captive, that captive earns investment income on them. And that investment income can be converted back into grants and funding, an infrastructure with which you guys are already familiar, grants and funding for driving down the cost of risk. I mentioned in particular on catastrophe risk excess programs, a great tool there for driving down the cost of building up catastrophe layers. That's a classic model. What you can also do is take meaningfully higher retentions if the marketplace really isn't sustaining the kind of risk transfer model that you're looking to do, and create a funding mechanism for that as well. But the characteristics there are low frequency, high severity, things that get the board's attention as major, headline type cases, and it's when it's hard to place capacity. But you need to show that you are considering the exposure, you're setting money aside for the exposure that you're taking on from a rating agency standpoint, bonding, and from financial relationships. It's a great tool in that respect. Moving forward, outside of the retained risk finance bucket, hopefully, Dan, I've answered your question. On the risk continuum, you're in a couple spots. You take deductible programs, you have self-insured trusts, and hopefully you'll be participating on the single-parent captive type model as well. Moving out of the retained risk finance bucket and going into reinsurance, rate arbitrage, and capacity, I'd spoken about this a little earlier. Really what we're looking at here is scenarios where, whether it's by virtue of the cost of risk transfer or by virtue of the access to certain capacity, what we're looking at is a captive as an avenue, as a vehicle by which you can access markets that you can't necessarily access by buying just straight insurance, whether it's excess insurance or excess of self-insurance or deductible programs. There's a whole world of reinsurance out there that you don't have direct access to, that a captive can give you direct access to. And by virtue of utilizing a captive in that kind of a model, you have the opportunity to provide competition to your insurance markets, to drive down price, to take advantage of opportunistic scenarios in terms of price and capacity with respect to the risks that you transfer. I'm going to move on to a question that folks often ask about when it comes to captives. And if you Google captives, you will learn that Bermuda and Cayman and Vermont and Hawaii and Guernsey and Dublin and Luxembourg are probably the top captive domiciles in the world. And you know what, I'll jump forward on that since I'm talking about it now. Offshore, there are a host of jurisdictions, dozens of captive domiciles, and onshore in the U.S., right, there are over 31 states or jurisdictions that allow the formation of captives. Vermont being the number one, Hawaii being number two, and then Washington, D.C., South Carolina, New York, Arizona being amongst the top of the tier twos. What does it take to be a captive domicile? Well, essentially, you need to as a jurisdiction, enable the creation and regulation of captive insurance companies, meaning insurance companies that serve their owners or their owners' affiliates, as opposed to commercial insurance companies who just sell insurance to anyone that they can. A captive insurance company has a lighter regulatory regime, lighter touch regulatory regime than a commercial insurance company, partially because the consumer protection concerns aren't there, also because the volumes of business aren't there, and because the insureds of the captive are affiliated with the captive itself. So there's a model in which there isn't likely to be any dispute between the insurance company and the insured. So as a result, while it is a regulated body, it's not quite as heavily regulated as the Hartford Insurance Company is, as an example. So Vermont has now been captive domicile, I think, for 25 years, and is the premier onshore captive domicile. Hawaii is a very popular domicile for West Coast companies in particular. It, too, is a popular domicile. And I'm going to get back into what's popular. District of Columbia is a fantastic domicile. It has extraordinary breadth of captive utilization technologies and the infrastructure and corporate structure that one may want in forming a captive. South Carolina is fantastic as well, focused very much on medical malpractice and risk retention group type programs. Also, we're working with life insurance companies on creating their own captives. And then offshore, Bermuda is the original captive domicile. It's the largest captive domicile in the world. It's been around as a captive domicile since the 50s, since the first captives. Cayman Islands is the top domicile for not-for-profit health systems in the U.S. Guernsey, very UK-focused domicile. Dublin and Malta, very European-focused domicile. I don't have Luxembourg on the list, but most French companies will set up their captives in Luxembourg, in part because of certain tax efficiencies in doing so. But the captive, there are probably, I would say, 6,000 or 7,000 captives around the world. and many of which, well, the oldest captive that we work with at Willis is 35 years old. So we've had, there are captives that have a very, very long lifespan and continue to provide value across a long duration and expand their utilization, contract their utilization as needed by their owners. I'm going to take a step back and talk about what makes a captive, what makes a domicile a good domicile. When we talk with the UC or anyone else about what is their optimal captive domicile, right? What we look for is we look for the place where the regulator and the client, in this case the UC, is going to fit well. And certain domiciles have appetites for certain kinds of business. So, as I mentioned, Cayman Islands is premier domicile for not-for-profit health systems. Bermuda is a top domicile, particularly for large global corporates that are U.S.-based. Vermont is a great domicile for U.S. organizations, also on the medical side, and for corporates, for large corporates in the U.S. Washington D.C. is a fantastic domicile for those who are not-for-profit or governmental institutions who are looking to have more flexibility with respect to the corporate structure of their captives than the other domiciles necessarily, and also. So it's a dynamic of what it is you're trying to do, what it is they like to see, and then what is the quality of the domicile from the standpoint of regulators and their expertise, the quality of service providers locally, their history and reputation. The onshore domiciles are reviewed by the GAO and the NAIC, and as a result, there's some reasonably clear articulations of their reputation. But really, we're looking for stability of regulatory environment, flexibility with respect to both the insurance programs that you want to write and the way in which you manage the investments of them. You want to be able to do business in that domicile without being overly burdened by regulatory regimes, but also be in a suitably regulated environment that delivers the second set of eyes, or in this case, the third, fourth, and fifth set of eyes for your retained risk finance program, and provides sensible but engaged regulation. That's what we like to see. There are financial outcomes associated with certain domiciles that for the UC are largely irrelevant. Whether it's tax deductibility or things along those lines, they aren't quite so relevant for the UC as a governmental instrumentality. But nonetheless, for other organizations, they can be very meaningful in terms of the decision making. Moving forward, when we talk about the development process around a captive, we build captives both strategically and tactically. And when I say that, I say we build a captive with an eye towards the insurance programs that are going to be written in it, but also with an eye towards how the captive ultimately will align itself with the organization and with the organization's strategic needs. So the utilization concept for captives is not just about, I want to write my workers' compensation deductible reimbursement today. It may be, the building of the captive may be focused on that, but a lot of the decision-making needs to also be focused on what is the broader utilization potential for the organization or for the captive, and how do we structure the captive to meet both today's needs and tomorrow's. So looking at insurance programs and risk appetites, running formal feasibility studies, which the University of California has done, business plan development, creating the company, and commencing operations. This is the basic captive development process, and it's a fairly dynamic process. Working with an organization to get a sense as to what is both the strategy in the long term for how a captive could be relevant, but also what are the tactical needs of the organization now for such a captive is one of the tricks of the trade that we in the consulting space work very hard to master. So hopefully over the course of time you'll find that we've done a good job there. But fundamentally, that's what we try to do in the captive development process. The final slide is really just a little bit on the captive practice at Willis. We manage captives in 25 domiciles around the world. We manage over 350 of them. We do consulting, captive management, and insurance program administration. And we're a meaningful organization in this particular space. I'm going to in terms of having a holding slide for the purpose of Q&A, I'm going to bring it back to captive utilization and open it up for any questions via the chat, or Emily, if you want to run questions, that's fine with me too. Dan, do you see organizations incorporating multiple strategies, meaning the captive utilization strategies? Absolutely yes. This is a captive is not a one-trick pony, and most organizations will start their captive with an eye towards, from a tactical standpoint, looking at retained risk finance, and will opportunistically deploy their captive in the risk transfer with the rates and capacity arbitrage model, and will then look for opportunities in the third-party space in order to either enhance enterprise risk management efforts or to access profitability of client insurance programs, which for the UC really isn't all that relevant. But certainly, the captive is meant to be a multi-strategy tool with respect to these kind of utilization technologies. I hope that answered your question. Excellent. I can rattle on this for the next 12 minutes if need be. Oh, thanks, Hans. What are the risks of going the captive route? When doing the feasibility study, what's the potential downside that gets evaluated? Sure. When a captive is used as a tool around retained risk finance, the risks are really no different than the risks of retaining that risk originally was when you did it. So in the retained risk finance model, the downside risk is that the captive doesn't have enough premium to pay for losses. But if you didn't have a captive, you'd have a self-insured trust, or you'd have a bank account set aside for funding that wouldn't have enough money in it to pay for losses. So it's the same from a risk retention standpoint as otherwise. When we get into risk transfer, rate arbitrage, and access to capacity, the risks there relate to the credit quality of the reinsurance that your captive is buying. When you use that model, you write a large insurance policy to yourself, and then your captive goes and buys reinsurance for it. Well, if you buy reinsurance from a bad reinsurance company, then you have a credit risk associated with that. So part of any kind of practice around risk transfer, rate arbitrage, and access to capacity utilization is always about underwriting the quality of the reinsurance that you're buying from a creditworthiness standpoint. And then on the third-party business side, right, the risks associated with that really relate to the question of are these enterprise risks? So I'm going to break away from enterprise risk to third-party risk, enterprise risk to entrepreneurial risk. So enterprise risk third-party and entrepreneurial third-party. Enterprise risk third-party is the same risk that you have organizationally now. When you look at a portfolio of stakeholders who contribute exposure to the organization, right, the risk there is that the risk overall is that they're contributing exposure to the organization, and you don't have ability to help to manage that or to mitigate that. And a captive improves your outlook in that particular outcome. The fundamental risk there is that the premiums associated with an insurance program, if your captive is help facilitating that insurance program, may or may not be sufficient to pay for the losses. So then that's true whether it's affiliate business or non-affiliate third-party business. So that's the downside risk there. Those are the a lot of things get evaluated. There's also regulatory compliance that needs to be managed particularly when dealing with third parties. But fundamentally, all that gets baked into the evaluation of any kind of an insurance program that gets used into a captive, that gets utilized in a captive. Part of what, whether it's retained risk finance, risk transfer, rate arbitrage, access to capacity, or third-party captive utilizations, be they affiliate or entrepreneurial, those kinds of the downside risk needs to be evaluated, and then the decision makers have an informed upside and downside review from a captive utilization standpoint. Hopefully that answered your question. And we have another question from Saladin. What is the Hans? Thanks for the thanks. Example: how long you might initially get a captive business, which not even some kind of category of the lines. Sure. A great model for launching a captive for the UC, in my view, is from a retained risk finance standpoint, looking at layers under your deductibles for the casualty program, like workers' compensation, auto, general liability, professional liability, employment practices liability, and to have the captive provide what we refer to as a working layer excess, so not all the way down to first dollar, but in the mid-volatile range around the risks that you're already retaining there. And in doing so, the captive can facilitate the management of funding between the various buckets of risk that you have. So it can be a great tool for managing the funding of the comp and auto and GL and EPL and professional liability risks that are currently under your deductible or self-insurance programs. What it can also do is provide the governance and visibility commentary that I was talking about earlier in the retained risk finance space. Additionally, using a captive to enhance the insurances around terrorism risk can be, in my view, a rather substantial upside. Whether it's really optimizing the conventional terrorism insurance program on the property side, and marrying that potentially with the inclusion of nuclear, biological, chemical, and radiological insurance coverage, terrorism insurance coverage, that too is an opportunity. And then thirdly, on the affiliate third-party side, helping to support small, growing, nascent insurance programs around vendors, as an example, could be also a great tool for the captive for a launch. I would be concentrating on the retained risk finance and access to capacity, the terrorism side of it first. And then over the course of time, I'll look to expand that out into any other areas of retained risk and any other areas of enterprise risk management-oriented affiliate risk where there's an opportunity to lever underwriting outcomes and really the captive model to support the building of kind of enterprise risk management, driving down loss costs, reducing claims, and just having better compliance around insurance programs across the organization. And then, of course, at any time on an opportunistic basis, look for opportunities in the risk transfer rate and access to capacity as part of the strategy. Hopefully I've answered the question solidly. All right. Well, we'll give it another minute or so for any additional questions, but I very much appreciate the opportunity to speak with everyone. Hopefully this has made some sense. There are folks that have been in the insurance space for 25 years that have not encountered captives, so this is a bit of a deep dive and technically potentially a little aggressive. Hopefully we'll have an opportunity to do a second one of these where we can drill down further into some of the Q&A, but also into some of the technical aspects of captive feasibility, and that may make some sense. So.
Thank you very much, Sean. It was really a terrific presentation. This is Katie Pickard here.
Thank you, Katie.
Well, it sounds like there are no further questions, so we will wrap up the Toolbox webinar for this month. Thank you very much for joining us. The recording will be up on our website shortly. And if you have any questions or would like a copy of the slides, please feel free to email me at emily.breed@ucop.edu. Thanks again.
Thank you.
Take care, all. Cheers.
Thank you. Please stand by.